your write-up was this idea that we aren't seeing inflation like we are here in the United States in other parts of the world. Talk to us a little bit about that idea.
So if you take a step back for a second, if you look over, say, the past 20 years, the United States has grown its broad money supply at a little bit faster rate than Europe, not by much. And both of them have grown their money supply at a much faster rate than Japan. So people often think Japan's printing a ton of money, but again, we talked about, I think, this in previous podcasts. There's a difference between base money and broad money. And so Japan's broad money is actually like the slowest increasing in the world. And so if you rank those regions by, inflation, the United States has had the most, Europe's had less than that, and Japan's had way less. And so basically, if you have two economies and they go through this pandemic, and one economy does not do fiscal stimulus, they're going to have a reduction in demand for certain goods because some people are out of a job, people are tightening their belts more, and so there's a reduction in demand as well as a reduction in supply. And so you'll still have these certain areas of constraint that are challenged, but on a broad sense, you probably want to have a lot of prices going up. On the other hand, if you have another economy where they have the same supply constraints due to the issue, but then they also print money and give it to people, then they're going to have demand go up to where, back up to normal or even higher than normal, but supply is constrained. And so they're going to have more inflation. And so, and people can debate whether that's good or bad. I mean, basically you'll get a faster rebound in nominal GDP and probably higher consumer sentiment, things like that. But you'll also have more inflation, more constraints. And part of it comes down to the pre-existing condition. And so we talked before about how the United States has higher wealth concentration than most other developed countries. We have a higher rate of people that are paycheck to paycheck, which is, I think, is played into the reason of why we did bigger fiscal stimulus than many other countries, because we had, say, a larger percentage of our population vulnerable to not having a job for 6 months, for example. So that was kind of the consequence of doing that. And I think that would go down, that would go back to like the Ray Dalio long-term debt cycle phenomenon, where, I mean, there were a lot of papers that predicted this would happen in the next downturn, even though obviously they didn't predict a pandemic. They were like, next time we have a downturn, we're going to monetary policy 3, as Dalio would call it, where we're just going to hand out helicopter money, we're going to monetize it, and we're going to hold rates low even if there's inflation. So it's kind of like we're walking through this playbook. It's almost eerie how much we followed that, and that's really because of a lot of the pre-existing conditions in the system.
So, what are your thoughts on the forward guidance that we're having right now, and then the chances that that could actually be a mistake, and then what kind of response are we going to see next relative to the response we just saw through COVID?
Yeah, so I really wouldn't want Powell's job here. He really doesn't want another pivot named after him, right? So like the Powell pivot from early 2019 after the big Q4 2018 sell-off where he tried to tighten. He talked about how it was on autopilot, and then the stock market fell 20%, but more importantly, the junk bond market totally froze up for 6 weeks. Just credit froze. And so that was kind of like the iceberg under this, that was the issue under the surface. Most retail were looking at the stock market, whereas like Powell was looking at the credit market most likely,
Mm-hmm.
and panicking. And so he had to pivot and be like, no, we're just kidding. We're not on all of autopilot. We're data dependent, and we're not gonna just ignore your signals. So he did the famous Powell pivot. And so I think the last thing he wants is to try to tighten into this. And so what we saw back then was, if you looked at GDP growth rates, it peaked around mid 2018 and started to decelerate. So we were not in a recession yet. We didn't have negative GDP growth, but we had decelerating positive growth. And so they were tightening into a decelerating economy, which
Yeah.
opens up issues. And so actually we see kind of the same thing now, where the economy in rate of change terms, GDP, probably peaked in Q2 of this year. You have the base effects and you have the stimulus and all that. And so now we're decelerating in positive territory. There are some metrics like retail sales that are outright, going down a little bit. And they're gonna potentially be tightening into that. Now it's a little bit different because back in 2018, they were actually tightening. They were doing quantitative tightening
Yeah.
and raising rates. Now it's more just like, do you want to be super dovish or hyper dovish, right? So they're getting less dovish rather than actually tightening, which is you're tightening rate of change terms, but you're still not actually tightening. So they have a higher chance of getting away with some of that because they've already, we're seeing so much reverse repo activity in the market. There's basically banks are stuffed full of cash. Other financial institutions are stuffed full of cash. There's collateral shortages in the treasury market, in part because the Fed bought so many of them, and also because the debt ceiling and the TGA drawdown, so that the treasury has issued fewer treasuries than they otherwise plan to do by this point because they're
Mhm.
constrained. And so you have a treasury shortage. So if they were to buy fewer treasuries, it actually probably wouldn't be the end of the world for a period of time. I think they have some runway to actually taper to some extent, but they clearly want to push that as far as they can before they go. The other challenge, the reason I wouldn't want his job, is because again, going back to the long-term debt cycle thing, when debt is this high of a percentage of GDP, you pretty much need a long period of negative real rates in order to make the numbers work. And so it's kind of like you got to inflate away the debt without saying you're inflating away the debt because it's
Like
not.
how long, Lynn? How when you're saying a long period of time, like what are we talking?
I mean, that would depend on the speed. I mean, in the 40s, you spent a decade with deeply negative real yields, and then you had a couple decades where you kind of broke even, and then you had the 70s, which was another decade of deeply negative real yields. And so it partially depends on how negative they get, right? I mean, it's a question of both magnitude and duration. Um, but they can't. That's not a mandate, so they can't say that out loud. So back in the 40s, in order to fight World War II, the Fed was pretty much captured by the Treasury. They gave up any pretense of independence and were captured until like 1951. Um, and so they're kind of in that situation now where they were kind of like pseudo, gave up independence for a period of time, monetizing debt, doing everything they can, but they don't want to give that illusion that they're just going to inflate away the debt, have people lose confidence in the currency. So they're kind of playing the narrative game where they're saying we're going to be accommodative, but no, we're not monetizing the deficit. We're not going to devalue the currency significantly. And so that's a really challenging environment. So they can't say out loud, we have to hold rates, zero while inflation's running hot because, federal debt to GDP is 130%. That's not the part they can say out loud. So they have to say like, we want to be accommodative until we have maximum employment. We think the inflation is transitory. So they have to kind of dance around the issue, and it's a really challenging thing. So that's why, as much as people like to blame the Fed, a lot of my blame is say back in the Greenspan era where they did have more levers they could pull. They could have made better choices, I think. And now they're stuck in a corner where they don't really have that many options. And so you're choosing between bad options, essentially.
They definitely weren't dealing with all the memes back in the 1940s.
Yeah, I mean, but that's the good point there. I mean, basically, information travels faster now, whether
Yeah,
in meme form or anything else. And so in the 1940s, you would get a newspaper,
you'd get away with it. Yeah,
yeah, you get away with things, and now it's like Twitter's monitoring it minute by minute, and people that work in like a grocery store can tell you who the chairman of the Federal Reserve is, and like it's not is it this information has traveled far quicker, and more people are aware of it, and that's part of the populism that we find ourselves in now, where everybody knows something's wrong with the financial system. There's different opinions as to what's wrong with it, different levels of information about what might be wrong with it, but it's kind of something that we all understand to different degrees. And information travels super quick. And so it's really hard to keep people in the dark about what's happening.